Hey everyone, welcome to this week's Nasdaq Dorsey Wright podcast. Joseph and I are here Thursday, September 28th, talking about markets as we tend to do. Joseph, let's just start with your thoughts this week. Broadly, what's market kind of pricing in right now, reacting to, in your view?
Yeah, I mean, we've seen a pretty healthy exhale in the equity market. The bond market has continued to feel pain. Pretty much a lot of it's been resulting from, comments made by the Fed last week, or at least that was kind of the trigger for what we've seen. I think, even prior to this, we had talked about in our research a decent amount how we felt kind of in need of some type of pullback. They had just run up so much over the past couple of months. A lot of those charts hadn't had support get established at lower levels. So we're kind of seeing that now, I think. Now, on a longer term basis, I don't really think we're out of the woods. If you look through, a chart like the S&P equal weight, for example, I mean, it's just like, you're kind of in the middle of this range that you've been in for quite a while now. I think the S&P has pretty resistance up there now at 4,600, which I think it'll take a lot to get through. And, this has led to some short-term, kind of oversold readings. I think if you look at both the S&P equal weight, the Nasdaq 100, the S&P itself, all those are in heavily oversold territory in their 10-week trading bands. You've seen the 10-week for the S&P 500, which tracks the percentage of stocks trading above their 50-day moving average. That reached that's sub 20% right now, which is usually a level where we start to see some type of bounce form from those. Below 10% is really washed out, which we got to last year a couple times. This year, I think in March it was closer to around 16, 18%. So nonetheless, we're at pretty what I would call washed out levels on a short-term basis, but not necessarily on a long-term. You look like the PTSPX for the positive indicator, that's still at like 54%. So, from a short-term basis, I think some of the downside, you could see a little bounce here. From the long-term perspective, I think things are still very mixed at best, and there's definitely room for more downside in the future. But I do think, over the next couple of weeks, we'll see some type of calm take over the market, at least relative to the past week. And then, another thing I like to look at is just what is vol doing? What does the VIX look like? I know everybody says the VIX is broken, but one thing I like to look at is the spot VIX getting above the 1 month futures contract for the VIX. And we did this morning see the VIX get above that front month on the future contract, which is usually a sign that you're seeing that short-term vol reach some heightened levels where it may start to pull back. And really the VIX is still sub 20, so I wouldn't even say we're in a high vol environment, but just that spot VIX versus the futures, that's usually a good sign that you may see some type of bounce. And I think we're seeing that a bit today.
Yeah, no, that makes sense. Yeah, I want to double back on it is what you're saying is that we've seen a lot of places get oversold, but maybe not washed out would be the summary here. So from oversold conditions, you can expect an oversold bounce to the upside, but from washed out conditions, you typically expect something with a greater magnitude, something that's a bit more sticky. So in our lingo, we're looking at bullish percents, sub 30%, 10-week charts, sub 10%. Neither of those are the case. We've gotten close on some, but we didn't get below those levels. So I would agree in that oversold bounce. Maybe that's what we're getting today, back half of yesterday. And I continue to look forward to that. To be honest, looks like we still may have a bit of room to go. People also, I think this is probably, everyone's just screaming about September online. It feels like, every technician anywhere, anybody watching CNBC, the Today Show is probably talking about like September market seasonality at this point.
Yeah.
But back half of September, typically pretty weak. This is like on command. Back half of September is pretty bad. I think the last week in particular is traditionally pretty poor. So the market's following its seasonal tendencies very well this year. If you look at, VIX progressions, you look at SPX progressions, all of that is trending really well. So it shouldn't be too much of a surprise, especially like you said before, we were expecting some of this pullback to come. The timing is always really difficult, as it is with anything in the market. But that is some sort of comfort, is that we are following a lot of historical tendencies here. The positive would be the year end. We would hope to see be good. We know October can be a bit volatile one way or the other. To keep myself from rambling here, I also want to mention some of those specific like equity indicators that we were seeing in washed out territory. You mentioned the equal weight chart for the S&P. I concur that it doesn't look great long term. It looks really choppy, kind of directionless from a longer term point of view. If you look at that weekly overbought oversold value, so that's our 10 weeks of price data, we're seeing how abnormal is the current price fluctuation. That's a kind of a heady way of saying it, but it's at the bottom of the trading band, which tells us that statistically you would expect a bounce. It doesn't tend to stay down here very long. It's actually the most oversold since April of 2020, and we know that was a bit of a market anomaly. But from there, you saw at least a bounce in the near term. Russell 2000, similar picture, bottom of its trading band, one of the most oversold that we've seen. Heck, consumer staples was the most oversold that it had been. XLP was the most oversold since April of 20. So all of that together, you can say that, a couple weeks out, month out, I mean, I think it would make sense to see a bounce. And we're seeing some of that right now. And there's some others too. I'll probably talk about this in the report tomorrow, then I'll let you get back to sharing your thoughts. The WD SPX, that's the weekly distribution for the S&P 500. It's taken those overbought, oversold readings for every single member in the S&P 500 and then averaging them. That's down at minus 47. That's also not super common that you see WD SPX get sub minus 45. Forward returns from there have often been positive in the near term. So just kind of building weight of the evidence. Then I think we get some additional confirmation from the moves that we saw in yields as well as the US dollar, which we haven't touched on too much yet.
Yeah, I mean, I think we can talk about equities, but I think the big talking point over the last week has been what rates have done. I listened to the FOMC last week, and I thought it was the least confident Powell sounded in quite some time, especially after what I thought. I thought he was pretty confident the prior few meetings, really talking about how they felt like inflation was coming down, and they had kind of not necessarily declared victory, but they definitely felt confident in the path that they were heading down. And last week felt the exact opposite. And their economic projections showed that they expected rates to stay higher than expected over the next years. And we've seen the bond market start to adjust to that, further out on the curve. Our U.S. government long group on the asset class group scores page hit its lowest score with history going back to 2003. So it is lowest score in 20 years, and is the last ranked group on the asset class group scores page. So talk about a group that, where you could see some type of short-term bounce. That's the
TLT, right?
Yeah, that's
second.
Well, you can look at
second
TLT.
Highest volume year to date. Is that right? Behind.
Yeah. We were talking about that. John Lewis mentioned that on the research call this morning, that TLT has the second highest inflows, only behind VOO, which is the Vanguard S&P 500 ETF. So
yeah,
people are still buying their long duration bonds, and at least in the ETF format. I think from what I've seen, a lot of hedges are short the long duration. They're probably feeling pretty good right now. But I think, when you get these violent moves and these violent repricing, there's always a tendency for the market to overreact, which is why we oftentimes see these bounces. So, I think rates would not shock me to pull back quite a bit, especially if you get 10 plus out on the 10 years plus on the yield curve. I think the front end of the curve is standing pretty firm. Maybe we'll talk about, the opportunity that the two-year range kind of offers you on the yield curve. But, that further out, I would not be shocked to see a bounce. You look at the dollar, that reached its most oversold, or excuse me, overbought level since, I think you mentioned it. I don't remember the date
Yeah,
exactly, but
March
it's
of
been like
15.
8 years, right?
Yeah,
Yeah,
March 2015.
which is just crazy. Chart is shot back up after being in a negative trend for quite a while. So it's not surprising to see some type of pullback in the dollar, which that dollar index is down about 45 basis points today. The 10-year yield is spiked up and then pulled back down, at least at the time I was recording, around 115. So we're kind of seeing that bounce across the market. And, it's not too surprising that we saw the dollar and rates rapidly move higher after that Fed meeting when they projected rates to be higher over the next couple of years. So the market's just kind of adjusting to that.
Yeah, sticking with the U.S. dollar comments, I put a piece out yesterday talking about the correlation between the dollar and crude oil going higher right now, or co-movement. Dollars going up, crude oil has tended to be going up most of the time lately. I've seen some others mention that as well. We're talking about how it's a bit of a cycle where if crude oil spikes, commodity prices spike, or that fuels commodity inflation, fuels data-driven decision type of inflation, and then kind of spurs rates higher and so forth, and it's just this cycle. So maybe that's some of the rationale there. And then also just talking about the U.S. dollar typically is a big headwind for international equities. We've seen that be the case so far. EEM, broad emerging markets, EEFA, developed, both have been on the struggle bus lately as well.
Mm-hmm. Yeah, I mean, everything's kind of moving how you would expect it to move, except the dollar higher, crude higher. But we are in this
Yeah,
environment where inflation's a big concern. So higher inflation means the Fed's more likely to keep rates higher, and yada yada.
Stronger domestic currency, so forth. Yeah, no, that makes sense. And you were saying earlier how the market tends to overreact to things in the short term. It's that famous quote. It's like, what is it? The market's a voting machine in the short term, then a weighing machine in the long term.
Mm-hmm.
That reminded me how things can get a bit out of whack. But for now, in aggregate, we're seeing some of the mean reversion that we'd expect from fixed income, from dollar, from even commodities, equities. Where that lands, we don't know. You mentioned, I think midpoint on the trading band is actually a pretty decent spot for a lot of these areas to be looking. You mentioned like S&P 500. That midpoint is around 4,400, 4,400, 4,450, or yeah, 4,400, yeah, 4,450, excuse me. I think anywhere in there would be an expected bounce from here. Not to say we're going to get there, but if you want to level, that's what we'd be looking at, I think.
Yeah, and I'm pulling up the chart right now. I should have had it in front of you before, but that is also that 40 that 43.40 where we got to today is kind of where old support was as well. So that's not too surprising that we've kind of gotten back there. You often see a retest after you break a big support level. And yeah, I mean, I think that big point there where the big break really happened was around 44.40, 44.50, which also would not shock me. I think what you're really concerned with is if you get back up there and then you reverse back down on that default chart. I mean, that kind of puts in a series, kind of an odd series, but a series of lower highs, which is never a good sign. And then you don't really have any support down until like that 42.40 area, which we got to earlier this week.
Yeah.
And that opens up, I think, the big level that I would be looking at for, other than 4,600 on the upside is going to be that 4,200, which is where we had a lot of consolidation in April and May. And it felt like the market was just, lulling you to sleep. And then right at the end of May, early June, we popped out through that 4,200 and we just really never looked back for the next 2 months, essentially. So, 4,200, I think, is going to be a big battleground if we do get there, which it wouldn't surprise me to get there eventually. Like you said, I think we're in short-term bounce territory, but not long-term watched out territory.
Right.
So I think those levels are still very open. And I would expect to see some fireworks at 4,200. If that holds, I think you could see a lot of upside after that. If that breaks down, I think it does open up some of those lows from March of this year, but even some of the stuff from last year potentially. But my first area would be like around that 3,800 where we got to in March of this year during the regional banking situation.
That makes sense. That makes sense. Well, cool. Any other thoughts or things that we said we were going to talk about and we didn't?
I think we touched on the big things. We touched on rates, dollar, equities, crude. So I don't have too much to add. I think the main theme is we're seeing some mean reversion in the short term, but I don't really think we're out of the woods yet on a longer term basis with a lot of these, especially how a lot of these charts are shaken out. I think predominantly if you look at something like the S&P equal weight chart, that's not a pretty chart. And then something like the Russell 2000 as well. I don't think that's a pretty chart either.
Yeah. A somber note to end on, but probably a true one. So we'll do just that. Thanks everyone for the attention this week. We appreciate it. We'll be back again for next week's podcast.